And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show, presented by RIA Advisors.
And sometimes we talk about fun stuff. Once in a while. Welcome to Financial Fitness Friday. I'm Rich Rosso, CFP. Danny Ratliff, CFP squared. Thanks for being here. We appreciate it. Ready for the cold front? Is Danny ready? Got your plants covered?
I'm about as ready as I'm going to be.
It's going to be warm here compared to some other areas of the country. It's like a deep freeze.
Yeah. I feel like when it's as cold as it's going to be down here, we're not as prepared for it from an infrastructure perspective. From just people being used to it.
Yeah, and I don't want my plants to die. Been trying to get my covers ready. Don't want to put them out yet, but at least it doesn't seem like it's going to be. There doesn't seem to be anyway. Looks like precipitation or a lot of it, so that's good.
No, that's great. Actually, I talked to a buddy yesterday, and he in oil and gas, and I think he said they have a operations in Calgary, and he said they have a flash warning, meaning that you're not supposed to go outside. Like negative 20.
Oh, some
so like
astronomical.
Shutting everything down for now.
Like as soon as you walk outside, it's like a movie. You freeze. You freeze up like immediately. Do you ever see those videos where the people throw hot water, and then it just turns into snow? Or
yeah, I'm looking forward to doing some of that this weekend.
Yeah, I bet you're going to be doing that.
Yeah, just no hot water on the windshield, okay, guys?
Oh, no.
No.
Seems like every year you got to remind somebody, though.
Those are great videos, too.
Yeah.
But again, no precipitation. That's good. But it's going to be cold. And speaking of cold, it's earnings season, and the banks are sort of ugly this morning. JP Morgan reported unimpressive numbers. We had Bank of America lower fourth quarter profits due to regulatory charges. So it doesn't look like banks are off to a good start, Danny.
No, and that's a bellwether typically of what we can expect moving forward. But, I mean, this time could be a tad bit different in the sense that, a lot of regulatory fines. JP Morgan mentioned that, the regional bank, the additional fees that were needed to prop those guys up here earlier in the year certainly hurt. I don't know what to be taken from that. I need to spend a little bit more time in the numbers, see exactly what these guys say, but got to take it with a grain of salt.
Well, yeah, it just it sort of gets the animal spirits off.
It does. Sets the tone for an interesting earnings season here.
And there's also concern over rising losses from commercial loans, especially office building debt. You had banks that have to pay higher interest on certain instruments, right? Of course, and then their bonds are down in value. And again, I think Jamie Morgan, he was a great actor, wasn't he?
Jamie
Dimon is, I think he's been sort of wishy-washy on the whole recession talk, but he's skeptical of this soft landing, and I think we all should be skeptical. There's just there's still a lot of cash sloshing out there. I still see the commercial for COVID relief funds on air. There's still a lot of money out there that people can get.
Wow.
So the government still has money out there, the infrastructure bills and so forth. Speaking of infrastructure, so we're going to talk about the retirement income death spiral, and we're all supposed to go like this. That's what we're supposed to do. But what causes a problem for retirement income is sequence of returns risk, right? Where you get lower returns over a sequence of years through withdrawal stage. That's a problem. Excuse me. That's also a problem for accumulators because it just makes you frustrated, right? I'm putting money into accounts and nothing's happening. So what I'm going to notice, Danny, I think there's going to be this reemergent talk from Wall Street about hedge funds and alt investments. So BlackRock comes out and buys a company called Global Infrastructure Partners for $12.5 billion. So that's a company that does long-term bets on energy infrastructure, digital infrastructure. Again, it's going to be an alternate for portfolios, because what's going to happen most likely is people are going to get frustrated with traditional stocks and bonds. But you got to be real careful with alternatives in hedge funds. So we're really going to talk about this, but Danny, once you venture outside of traditional assets, and I'm talking about most investors. Some investors are what we call accredited, although I can poke some holes into the definition of that based on what I see people invest in. You got to have rules around what you're going to do, why you're going to do it, how much of it should be in your portfolio, and then how should you segment it. And part of it is also because of the new Bitcoin ETFs, right? There's nothing wrong with looking at hedge funds, alternatives. But you have to remember is you cannot comprise your entire portfolio, or should you, in these alternatives or these different ways of investing. What do you think is some of the reasons for that? One, we know are much higher fees. You're going to be paying for that.
Well, I think that's where you need to be cautious with any advisor, anybody you deal with, in the sense of understanding, okay, what you're paying them, but then on top of that, do you pay additional fees? So a lot of people, separately managed accounts are referenced as SMAs commonly in the financial world. And, there are some benefits to them. The biggest thing that most people discuss is tax loss harvesting, the ability for you to personally own those individual stocks, not just own a big mutual fund or even an ETF for that matter. But the problem with that is that you're typically paying an advisor and then paying another advisor on top. That's not always the case, but more often than not it is. And so now you have to understand what are those fees. Just like if you were to go buy, have a professional money manager and then they're going and buying a bunch of mutual funds, those costs begin to add up. Now, the alternative products, that fee structure is generally quite a bit more lofty. So where you may see a common expense ratio of anywhere between 0.6 and 1% on an A share, or institutional, it may be more like 0.5% or less. These, we're talking a lot of times, Rich, you see them, 1.5%, 2.5%?
Over 2%.
Sometimes more.
Yeah.
And so that's where you need to really get a good understanding is, okay, how are you paying them? And what does that mean for you? And then what exactly will they do? Now, many of these are so niche oriented, they could be great one year and then really be down in the bottom quartile the following. And so knowing and understanding that, you're investing sometimes in a theme, understand also what is a caveat to get out. This is one thing I think catches a lot of people by surprise as well, is that there may be redemption periods that you're not aware of. And meaning that if you need liquidity, you need to get out of something, it may not be within the time frame that you think, or they may actually go out and shut it down based on market dynamics, the conditions that they're dealing with. So there's a lot of moving parts when it comes to alternatives that I think people need to be aware of. It's not as clear cut as what most would think. I think it's great that more people can assess different types of investment strategies and themes, but be careful, because a lot of these big institutions develop these as a product, not as a solution. And so be very, very cautious with that.
Yeah, we're going to continue this discussion on the other side of the break. You're listening to Financial Fitness Friday. Be right back.
Step into the confusion. Can't you hear the sound that's in the air? It's rock and roll. It's rock and roll.
Daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back. Wow, Bank of America profits are off like 50%. That's pretty significant.
Oh, it's a bit concerning. But I think you could expect that amongst a lot of these banks. I mean, look what interest rates have done. And that is why the Fed, we haven't pivoted quite yet, but the verbiage has certainly changed and changed quickly. I mean, you're still, CME Fed Watch tool still has 63% odds of a rate hike in March.
Yeah.
Yet we did see higher CPI. You do look at core CPI, though, and it is coming down slightly. But, I don't think this is just a straight line drop like most people expect. This will take some time. And, we're getting a lot more questions around bonds, too. Like, okay, well, rates, they went up significantly. They've dropped quite a bit. Now they're kind of inching their way higher. We got a little bit over 4% yesterday in the 10-year Treasury.
Yep.
Down slightly this morning. We'll see where it goes. But, we have to remember as well that some of these things were so overdone that you're going to see that natural reflexive move in it.
Absolutely. Pendulum swung too far.
It'll come back a bit. And so that could be an opportunity because we do know over time this should come down. Now, a lot of moving parts that they have to deal with. And this is not going to be just clear cut. I mean, clearly, moving into this, Jerome Powell said, hey, prior to this, inflation's transitory. We're not going to be hiking interest rates. Boom, go on the fastest rate hiking expedition they have been on. And that doesn't mean on the other end that we're going to just start cutting dramatically. If we do, it won't be good for the economy overall because if they're going to cut dramatically and very quickly,
something's wrong.
Yeah, something's wrong. So bonds may do great. Stocks, alternatives, that may not be the place to be.
Absolutely. You got to think about this whole narrative, and Michael Leibowitz has written about it, the Goldilocks syndrome, and that's perfectly fine. Everything's not too hot, not too cold. But somewhere outside of the three bears, there's a cocaine bear that wants to devour Goldilocks. And one of those could be the banks. One of those bears could be the Fed. Because obviously the markets are just, that's all they care about is interest rates and the Fed. And I understand Marty Zweig said, don't fight the Fed and interest rates are important, but we are hyper-focused on it. So we'll see where earnings go, but banks set the tone, and I wasn't expecting anything really great from banks. I didn't expect some of these to be as bad as they were because I'm just not a big fan of Bank of America. I just don't think it's one of those better banks. It's just sort of slogs along. But the point is, this sets the tone. We have to see where it goes. As Lance talks about, the first couple of months of an election cycle, the first couple of months of the year, you're going to be sort of wishy-washy. Then we're going to have to see where it goes. But this goes back to the discussion about hedge funds and alts. So right now, BlackRock collects about 3% of their fees, total fees from alts. They're looking to increase it to 10%. What are they seeing that other people aren't? What they're seeing is stocks are expensive. You could have greater sequence of returns risk, which is how our financial plans are designed for forward-looking returns. And people are going to want things. And since Wall Street is a marketing machine, the sexier it sounds, the more dangerous it is. You know, it's like dudes out there at Mastro's at the bar on Saturday night. Sexy, but expensive and dangerous. How'd you like that? I haven't been to Mastro's in so long. But what I'm saying is, the sexier the investment, Amy, I haven't been to Mastro's. The sexier the investment, the more you should be skeptical of it. The more homework you need to do. Heck, look with ESG, not considered sexy, but a great marketing scheme, which Lance was on to early on. And look at the fees there, right? Because I think I'm doing the right thing for the planet. What you were doing was the right thing for Larry Fink's pocketbook. That's what you were doing. So now you go into alts. You've got multiple Bitcoin ETFs, although the fees on those are fairly reasonable. And some of those ETFs are going to waive fees for a period of time. And we'll see who rises, which one of these fund groups rise. But what I worry about, again, Danny, is when it comes to alts, and there are a lot of ETFs that do merger arbitrage, acquisition. They try to mirror hedge funds. They're fine. But to Danny's point earlier, they're not gonna move most likely with the rest of your portfolio, which is really why you own an alt. It's totally going to be different, and the correlations are going to be totally different or negatively correlated to the rest of the portfolio. So when you're happy with your alt, you're probably not happy with your overall portfolio, and vice versa. So it's a way to dilute risk.
Yeah.
But I don't think most investors are sophisticated enough to look at it beyond the narrative. Oh, this sounds cool, or whatever it is. And then they're going to put too much money in it, get frustrated at the very wrong time, and sell. So sequence of return risk or low returns on traditional assets over time are going to cause you to get frustrated and make bad decisions without doing your homework and setting up rules for these alts. You know, it's just like, okay, I understand dogs. I have dogs, and I know how they move throughout the house, and I got their routine, and now I'm going to own a woolly mammoth. And I think I'm going to apply the same kinds of prowess and skills to managing the woolly mammoth. I'm okay with stocks and bonds. I understand how they work. Now I'm going to bring this other thing in, and I'm going to give it a big part of my portfolio. That's not the right way to do it. So it's okay to own a Bitcoin ETF. It's okay to own some part of an alt asset infrastructure fund, whatever it is. But keep in mind, there are studies that are done on hedge funds that show they correlate most with intermediate term bond funds for 3 times the cost. They're giving you returns on average of about 4% for much higher cost. So they're correlating more with bonds than stocks when studies are done on hedge funds. And again, I'm not against people looking to be more adventurous with some part of their money, Danny. It's just that the do your homework part, and then understanding even if you do it, you're going to be frustrated probably and pay more money because if it's doing what you expect it to do, you're probably going to be very frustrated at times because you need to have a really longer term time frame for these things to pan out.
Well, what concerns me too is like the accessibility to it. I think is great, but look at like the Bitcoin ETFs. Let's use that as an example. Now, let's say they start popping up in 401ks.
Yeah,
you're talking about an asset that is highly speculative, very volatile, that should be used if you're going to use it for a small portion of funds overall looking at your big picture. Whereas I think you get people who get very speculative. They think, okay, look, they look back. How do most people pick their 401k positions? No, I'm serious.
Magic 8 Ball?
No. They go back. They look at the performance.
Oh, they get past performance.
Past performance. They say, oh, okay, that one's
That's
doing
going to
really
mean
well.
I'm going to project
This
it
one.
into the future. Yeah.
Correct. And so that's what scares me, especially after you've had, Bitcoin's been on a tear here. Some recent. A lot of people will see that and say, oh, man, okay, we're going to get in here. Or, you hear the stories or you talk to people. I talk to people close to retirement. Hey, I haven't done as good of a job as I think I needed to. I want to maintain this lifestyle. I need to put aside more funds. Mm-hmm. Or I need to become much more aggressive. Most of the time, people, you hear this a lot. They say, I'm going to be more aggressive now to make up for lost years that I didn't put funds aside. And what risk does that come with? You talk about sequence of return risk. Now it's humongous.
This is going to sound really bossy like AOC.
Oh.
All right. Okay, this is going to sound really bossy. Well, that was Jenny Yellen. How do I got to get my AOC impression down?
How do you do AOC?
I don't know.
Whenever
But here's the point I'm trying to make. If
Usually a lot of likes.
if I'm an organization and I'm setting or establishing a 401k and I even allow an option to be self-directed, I am excluding all these Bitcoin ETFs, all 10 of them. I don't want my employees going near them because it's going to come back to me. So I'm not even going to offer them, Danny. I'm sorry. I'm very sorry.
Will, though.
I don't understand this whole garbage disposal thing, and I don't understand this. I don't understand Bitcoin. Is it going to bite me in the middle of the night like my boyfriend? What is it going to do? So I am saying I don't want this in my portfolio. I think if you want to do this outside your 401k with after-tax money or you have an IRA, go ahead. I wonder, Danny, if you buy these ETFs, like you're a retail investor and you go online, you go to Fidelity. I wonder if they have like a disclosure even before you click the submit button. I wonder if they're doing a CYA.
I doubt it.
Okay, just wondering. I would.
Well,
like,
it
you
would
understand
make
that this is
sense.
speculative. You got to understand what you're doing. You could lose all your money. I would be CYA up the CYA or CYA squared. So that's what I would be doing with these. And again, I have nothing against crypto, but I would have rules around what I would do. Then I've got 10 of these things now that are out. So you got to look at how institutional investors are going to look the ones who obviously have the largest trades, the most volume. Fees are they're not bad because there's going to be a fee war among these 10. So as sequence of return risk, and that's going to lead into the retirement income death spiral, as you have perhaps sequence of return risk, and again, this is how we've built our plans for years of frustrating returns, people are going to be seeking alts because they're sexy, they do something different, have rules to do so. Nothing wrong with it. I wish you the best with that type of investment. Especially people listen to this show and on YouTube. But I think sophisticated investors who spend a lot of time understand that there's risk of losing money. So I'm going to cordon this off and can corral this woolly mammoth so I can tame it.
There will be no disclosures on this, I can assure you. And I'll tell you why when we get back.
Okay. We'll be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts, Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere, Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You've heard about this quiet quitting where, I'm just not being paid enough to do my job, so I'm just going to not really do my job. They now have a thing called the Bare Minimum Monday.
The Real Investment Show podcast.
Basically just doing the bare minimum on Mondays just to get your paycheck and go home. Ultimately, the people who run the business go, well, if you're going to do the bare minimum, I'm going to do the bare minimum and not need you anymore.
At realinvestmentadvice.com.
At some point, somebody's got to work. That's kind of the way it works.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And we are back. So I know we've really kicked this topic around. I just want people to be aware of stories and seductive stories that wind up gaining your money, and then you lose money, or you become disenchanted to where you don't invest anymore in anything else, because you got sold this sexy investment or this alt fund or whatever it is. I have nothing against them, but I will corral them. And Danny and I just talking, Danny just brought it up, right? You look at Bitcoin, there's nothing behind Bitcoin. It's ethereal. It's like, I understand money could be too. I understand it's based on the faith that you have in the sovereign country. However, there's a country behind it to some degree, although I don't know where I live lately. But what I'm saying is, with Bitcoin, to your point, Danny, it's just, there's nothing. There's just nothing behind it. And then it's fine. How are you going to produce? That's the one thing I always wonder about, the energy and the production of Bitcoin. How's this going to happen in an ETF? Like, when there's been a finite number? Like what's the process behind this process?
What do you mean? As far as, if you need to go buy more shares?
Well, I mean, like Bitcoin itself. Like how Bitcoin is mined, right?
Correct.
You need you need all this power. AOC is going, my gosh, it's so expensive to make, and so much of the planet's going to die because of it.
I don't know how they make
money. I don't know why.
I haven't seen
a Bitcoin. Is it round? What exactly? How do you produce enough to do
That's a legitimate question. I mean, I think, you mentioned earlier that, this is going to be considered an actual asset class now. I mean, $4.6 billion went into this just yesterday, right? Crazy. Now, obviously, a lot of people waiting on the sidelines trying to get an understanding. If you were already in some of these, like GBTC, Grayscale Bitcoin Trust, you saw basically you were buying it at a discount.
Yeah.
And once it actually comes to market, right, you saw a nice bump. I think it was up like 10% yesterday. So then it goes to the NAV of what actually Bitcoin was.
Yeah.
Now, so I can see the advantage on something like that, but my problem is number one, like you mentioned, the supply aspect.
Yeah.
But what about the supply and demand from the other side of this, right? Mm-hmm. Where is that intrinsic value? If we go buy a company, we're buying its sales, we're buying, we're looking at its price to book. You're looking at the buildings. You're looking at so many different aspects of this, looking at all the assets.
Right.
I can't do that here.
No.
And I'm not saying that this is not a viable option for somebody to put funds to. But what I would like to caution is don't put everything to something like this.
Right.
Because that's where you get in trouble. As much as it went up so far in the last, 6 months, go look at the return prior to that.
Yeah.
And imagine you need these funds for retirement. And I know there's a ton of you out there saying you guys are idiots. This is the best thing since sliced bread.
Oh, I see them on TV every day.
I understand. That's fine.
They've come out of the woodwork.
But with anything like this, when you're talking about your livelihood, your financial security for you and your family, you cannot put all of your eggs in one basket.
No. I don't care what it is, but to your point, it's exactly true. You are basing this on there's this notion that Bitcoin is going to replace all currencies. And then Dorothy's going to wake up. That might happen when you're dead and gone. It's not going to help you for the time frame that you have to invest. The time frame for you have to invest is a speculation. And it can fall out of favor just as easy as not. But there will be, to Danny's point, demand because it will be inserted into portfolios. It will be pushed by advisors as BlackRock is the best thing in the world. I got to get in. Or whatever the heck it is. Stories are going to be rampant. So you know what I would do if I were an investor, Danny, and this is not a recommendation. I'm not touching this thing until the fever dies down. I am not going near it. I'll let it burn. I'll watch it. I'll monitor it. But there is no way in heck. If I were going to do it, I would do a very, very small percentage in value average in over time, which is sort of an oxymoron because there really is no value to Bitcoin. But that's what I sort of would do.
Yeah, and I think you need to be cautious when you look at these as well. I mean, are they using leverage inside of here?
You got to read. Got to do your homework.
There could be some other bigger issues with that. But, going back to before the break, you said, hey, would these companies require a disclosure?
Yeah.
I think it's doubtful. I mean, look at the big names, those top tickers here.
Like BlackRock.
ARK 21 shares.
Yeah.
Fidelity, Wisdom Tree, Invesco, Van Eck, Franklin Templeton, Grayscale, Bitwise, BlackRock, Valkyrie.
You're on your own.
These are all big firms, right? And you mentioned BlackRock, how they were such proponents of the ESG game, and all of a sudden they start to step away. You ever seen that Homer Simpson meme where he's like goes into the bushes?
Yeah, and he comes
slowly.
Out. I posted one of those where I said, this year is going to be different for me, and Homer Simpson goes into the bushes, and then he comes out a female. He's got a wig on.
Okay, I don't know how you got there, but that's what BlackRock is doing. They're going into the bushes, right? They've kind of stepped back on the ESG. And
what are they going to come out as?
But what happens? They came out as a Bitcoin ETF. That's what they came out as. So now what happens, though, if you do get a significant drop in this, if it goes down 50%, they start saying, whoa, risk rewards maybe not here.
You're saying Larry Fink is not really upset by all the energy it takes to produce Bitcoin? He just doesn't care, huh? Dare you?
Yeah, how do you square that with the ESG crowd?
You don't. Oh, he's been dumping that stuff.
You know?
Like, when they say ESG to him, he goes, me no speak English.
But the energy that it
I know.
is required to generate this stuff.
Oh, don't ask me. I have no idea.
Whole cities' lights dim when they start mining that stuff.
Yeah, I know. We've been on this topic a lot longer, but with the 10 Bitcoin ETFs out, BlackRock purchasing this huge fund because they see the writing on the wall. The one thing BlackRock does do a good job is making money, and they do know where the trend's going to go. And they know that sequence of return risk is coming. I'm completely convinced of that, and that people are going to be looking for more alts because what's going to happen is this euphoria from the Bitcoin is going to spill over. If I'm going to go here and own a woolly mammoth, then I should own a T-Rex too. Although I don't know if they were alive at the same time. I don't think so. But, okay, got to go back to my books.
What do you think T-Rexes ate?
Good
I'm
point.
kidding. I don't know either. But,
they can't clap or anything because
we're picking on BlackRock. We use a lot of BlackRock funds. I mean, we use iShares for ETFs. And we invest in ETFs.
Yeah.
I mean, there's a lot of good. But what I think Rich is really trying to get to is that when all of a sudden these new things come out with these shiny bows on them, be cautious.
Yes.
And also recognize that this may just be a theme. This may not be something that you can set it and forget it. It may have a very short shelf life. And so,
or I'm going to set it and never look at it because, in other words, I know this is going to be a supply and demand thing. If I put 2% in, I just might say I'm going to let it ride. But I understand what you mean. As it grows, say it does wind up becoming a bigger part of your portfolio, you're going to have to corral it.
Well, it's like any asset class.
Right.
I mean, you look at this, especially if you're kind of placing large bets on these things, you need to say, okay, well, at what point do I step out? Has the market changed? Have we seen a sector rotation? Those things happen.
They absolutely do. So we deal with a lot of people who need retirement income planning, tax-efficient withdrawals, Roth conversion. If you think your taxes are going to drop to the lowest level in retirement, you are mistaken. I mean, that does happen for some people. Like the story you all did, which was a great article in the Wall Street Journal about some people who live exclusively on Social Security.
A lot of people look at that real negatively. And I think that actually gives people hope in a lot of ways. Like, look, you can do it. It's not maybe what you envision.
No, you can.
And these people are happy, too, because they're still social. They still they engage, right? But
if you read the stories, I mean, there's some depressing ones in there, but for the most part, people are making do. They have small amount of assets outside. They have Social Security. Some of them have worked a part-time job. I work with clients right now who over 65 to 70% of their income is Social Security. But they work part-time. They have very reasonable expectations. Listen, it's all about your expectations and what you want. Mm-hmm. I'm not saying it's an ideal situation. You were talking about the guy that was living in his sister's basement, right? But there are people that are making do with it. And Social Security has become their pension. But if I do retirement income withdrawals from my variable assets like stocks and bonds, Monte Carlo, which is the simulation that we use for accumulation, doesn't work really well because it's based on conditions, sequence of return risk, longevity risk. So James Sandage, who's a really big fan of his work, actually we're coming up with a retirement boot camp. We're going to see a lot of his work in this because we follow a lot of this already. So we're going to talk about this retirement income debt spiral. Don't let it happen to you when we get back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Looking for clarity for your investments in the new year? You must attend our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere.
Trump will be a big presence. The bigger story, in my opinion, is how weak Joe Biden is going to be.
Is the Fed finished tightening?
Liquidity, I think, is underestimated.
Will rates ease this summer?
States are still flush with cash. They haven't spent all their money from the pandemic relief bill.
How will the election affect your investments?
I don't see any political figure right now who can bring the country conclusively back together again.
Register now for our 2024 Economic Summit, Navigating Markets in a Presidential Cycle, featuring Greg Valliere with special guest Adam Taggart, plus Michael Leibowitz and Lance Roberts. Saturday, January 27th at the Hotel Sonesta, Houston. Navigating Markets in a Presidential Cycle, featuring Greg Valliere. Saturday, January 27th at the Hotel Sonesta, Houston. Registration open now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Have the market's gyrations made you nervous? If so, it's because you have more risk in your portfolio than you realize. It's time to reevaluate your long-term investing strategy with RIA Advisors. Our disciplined approach can help eliminate unnecessary risk. We do that by having both a buy and sell discipline. Does your advisor do that? If you think it's time to work with an advisor who puts your interests first, it's time for real investment advice. RIA Advisors, 855-RIA-PLAN, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So this is along the lines of retirement income. Pete asks, my wife is 70 in the market 100%. I cannot convince her to get out of the market. What kind of advice would you give her? Well, I don't have enough information, but I will tell you, I do have clients who are older and they do have 100% in the market. One, because they understand individual stocks, they're fine with it. But most important, the money's a legacy asset, which means it's not for their lifetime. It's for children. So you have to expand that life expectancy and you'll get better returns because, right, you're investing aggressive for children. Also, people who have created a guaranteed income stream, they have pension or they have an annuity structure or they've taken Social Security properly, they don't care about the gyrations of the market. Their withdrawal rates are so low, if any. They can afford to be it because think about all the other stuff you're doing can be considered one big bond, right? And I collect my income. It pays for my fixed expenses. I know I'm never not going to get a check. So I'm going to let it ride here because I rarely need to take withdrawal. So there's a lot that goes into age and stocks. When you start looking at, hey, I need these variable assets to create a retirement income for me, then the equation totally changes. Then the allocation, absolutely, with valuations the way they are, too aggressive. Because what James shows in this work, first of all, negative returns. There's a critical point where negative momentum, you have market losses, withdrawals, and fees, overwhelm the positive momentum generated by positive returns. And then you go into this spiral very quickly of principal deterioration. That's why when people say you can just take 4% out of your account every year and not look at it, that is wrong. Wrong. You've got to look at your withdrawal periods. We look at it over a rolling 3 years. And make changes, perhaps, to how you spend money. People don't want to hear this because they're treating their variable assets like a guaranteed fixed income stream. And it's not that. Sure, when markets are going up and you've got a tailwind, then you take 4, 5, 6% and the money keeps growing. that's great. But where you retire in a cycle is pure luck. And I've been saying since 2019, retirees are in a headwind for returns. And I always look like a jerk for the first few years. And then it kicks in. So what this is talking about is to avoid the debt spiral, because by the time you find out about the debt spiral, it's too late. You've got to examine your withdrawal rates every year. You also then might have to make an adjustment to say, I am not going to increase my distribution for the following year. I might decrease my distribution for the following year. In other words, your goal is to make sure that that money lasts as long as you do. And depending on the cycle you're in, you're going to have a positive life cycle or a negative death cycle, depending upon the cycle. Well, Mark and Rich, stocks always go up. Yeah, I can show you every 100-year period where stocks go up. That's what Dracula does. Dracula doesn't have to worry because Dracula's got a very long life expectancy. You don't. Therefore, that's why James's work is so important. You can't mindlessly take withdrawals. I think that's the biggest message. And for advisors, a client can get into that negative debt spiral a lot quicker than you realize. Poor returns up front in the beginning of retirement, which is why our plans are set up to show turbulence in the beginning. He has one example, Danny, where one client started out and lost only 2.7% the first year of retirement, but still kept their withdrawal rate the same. And that portfolio deteriorated markedly more than did the following year, portfolio the following year that didn't suffer that loss. Because what he's showing is there were no adjustments made to change the withdrawal rate depending upon the cycle where you were. You got to manage that. It's called variable assets for a reason, right?
Yep.
So you have to look at accumulation and distribution as totally different structures. If in an accumulation cycle, you may not have more, you might, and you're in a poor sequence of returns, you'll get frustrated, you'll have lower returns, but you're not taking capital out. So you cannot just go blindly into the withdrawal process and think that, oh yeah, well this year I'm taking $35,000, $40,000 out of my portfolio. That's what I'm going to be able to do for the next 30 years, inflation adjusted, la, 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 la. Because that's how most plans work. That is not reality. That is not reality. So you want to avoid that spiral. And one way you do it is, what's your withdrawal rate for the cycle you're going to be going in based on valuations on the market right now, based on the Shiller PE, 31 times. Right?
Well, I think there's ways that you can avoid this. Well, I had this conversation with somebody the other day, and he said, listen, how do most people take distributions in retirement? Not at retirement quite yet. This gentleman is getting very, very close, has the means, the funds to do so, but very cognizant and aware of what that means when you have that poor sequence of return risk.
Yes.
So he says, do I have enough money in cash? So not only for quote unquote emergency, any big ticket items I may need, quickly, but that I can live on for 2 years.
Keep it in cash because you're going to be drawing from
cash alternative, something that's going to pay you a little bit of interest.
But I won't have principal. I don't have to worry about selling something at a loss.
That's right. But then, we have some clients that they want a check monthly in retirement. And that is probably the most common method.
Yes.
Because you feel like you have a paycheck, funds are coming in, it's automatic. You know exactly when you receive these funds. You go pay your bills, you can budget. Works out well. Some people do it quarterly. Some may do it, bi-weekly. I mean, there's a lot of different ways to do this. But he said, well, what if I only take from the portfolio? And not everybody has this luxury. But what if I only take from the portfolio in a really good year? And then I'll go refill that bucket.
Yeah. In other words, giving myself I get a nice bump. I'm going to take the bump, right?
Correct.
And like giving yourself a bonus.
Correct.
Yeah.
And so he's going ahead. He's not necessarily spending those funds right then, but he's to say, listen, I'm going to go replenish this bucket here, and then I'll be able to draw down from that. If the market goes down next year, And he's not taking a ton. He's just taking enough to live on.
Correct.
And then the following year, hey, it's a rough year. Maybe you don't make that distribution. You start to dwindle down the other bucket. You give your portfolio time to recoup.
Yes.
That can work well. Now,
it could.
You see this work, though, where sometimes it takes a much longer period of time to get back to even. And that's the one thing that I think that is difficult for many to understand when we think about market returns.
Yes.
Like you talk to somebody who's really aggressive. They're like, well, I can go make 50% in the market. Like, okay, what happens when you lose 50%?
Oh, I won't do that.
If I lose 50, I'll just make back 50 the next year and I'm back to even. Like, no. You lose 50 of 100. Let's just say 100,000, easy math. Now you have to make 100% just to get back to even.
Do you know what kills
Because we're working with much less capital.
You know what kills most investors? The ones that study the most. Overconfidence.
Overconfidence?
Like you said, I'll just get 50%, or that stock's going to come back.
So I see two things. It's either overconfidence or paralysis by analysis.
Yep.
It's just so much, you're like, I don't know what to do. But you know so much information. So it's tough.
It is. So what James created. But what you're saying, though, is he's actively managing
the distribution
strategy.
Yeah.
Yes. Which means those tweaks he's making are going to allow his portfolio longevity, as opposed to mindlessly taking 4, 6, or as Dave Ramsey says, 8% out of his portfolio. Imagine if you had taken 8% out of your portfolio in 2022 with what you probably lost.
So imagine what you need
to get back
to where you were. And this is another mistake I think a lot of people make.
Yeah.
We use the portfolio value at its highest.
We do. We mark to the high point. Yes.
Always.
Not to what you started with, but to the high point.
Yeah.
It's some magical number that makes people feel better. It's like a brain snuggie. But it doesn't matter. And if you're on a spend down plan, you are going to have less money as you move forward and get older. Why is it? I had $1.5 million and now it's $1.1 million. And I've been retired 15 years. Yeah.
You've taken out $800,000 but that surprises people as well. I think when they start to think back, say, wow, I did. Okay.
When you start going back and you tell people this has been your cumulative distribution. Oh, really? Yeah. You got to lump sum those numbers and hit people over the head with them. Hey, I'm going to hit you over the head with 800,000. Poof, poof, poof.
Well, I think why it's important too for people to have some funds on the side even during retirement, just enough, because what happens when all of a sudden, we plan as advisors for distributions, meaning that we typically are going to have some funds on the side. We're going to have some that are restricted so that you currently have. We're going to know how we're going to meet that income need. But if you start coming and knocking on the door, making a phone call every 2 or 3 weeks, saying, "Hey, I need an extra 15,000, 10,000." Then what do? You may be stuck where you have to sell at a bad time.
Absolutely, because you need the liquidity and you have to sell. So that's very true. Home equity line of credit, reverse mortgage, borrowing from life insurance. This is what we had people do during the financial crisis, to leave the money alone. And when it came back, we paid those loans back. That's all we got. Hey, listen, sign up for Greg Valliere, Navigating the Market in a Presidential Cycle. We'd love to have you there. RealInvestmentAdvice.com. Have a great weekend, everybody. Stay warm, if possible.